Hello, Nathan Stark here, and welcome to the Beginner's Corner. So, what are the mechanics of a stock's price action, and how does it work anyway? That's what we're going to cover today. Did you know a rock star's ticket prices can skyrocket or plunge similar to the stock market? Join me as we unravel these powerful dynamics together. Stocks move because money moves. Fear, greed, and everything in between drives this. Every tick in the stock market tells a story. Investors reacting, institutions maneuvering, algorithms calculating. But what really drives the chaos? Let's break it down. Just picture a world-renowned rock band announcing that they will be retiring soon, and the upcoming concert will be their last one. Before the announcements, tickets were selling for $150 each. As soon as the announcement came out, all the $150 tickets were immediately purchased, and for a moment there were no tickets for sale. A few days later, a handful of these tickets came available and were being sold by individuals for $200 a ticket. Again, all these tickets were immediately purchased. A few days later, more tickets came available for $300. Ultimately, these were the last tickets that were offered, and they were all soon sold. This is a great example of how buying power absorbed available tickets and pushed price up. The law of supply and demand. This principle says if there is more demand than supply, price will rise. And if there's more supply than demand, price will fall. This creates a common misconception relative to stocks. People often say price went up today because there are more buyers than sellers, or price went down today due to there's more sellers than buyers. This simplification creates some confusion. In reality, every trade involves both a buyer and a seller. Let me say that again. Every trade involves a buyer and a seller. So let's cover some basics. What is a stock exchange? A stock exchange is a regulated marketplace where investors buy and sell securities like stocks and bonds. You may have already heard about some of the better known stock exchanges, such as the New York Stock Exchange or the NASDAQ. How do prices move higher? Let's look at a screenshot of some interesting information about NVIDIA. The screenshot shown is called a level 2. Think of it as an order book. Don't let this screen intimidate you because it's very simple. Just like when somebody calls in a pizza shop and places an order, that order is placed on a ticket. The collection of those tickets, the orders, is the pizza place's order book, very similar to the NVIDIA's level 2 shown on a screenshot. When investors buy a stock, they purchase at the ask price, right here. The column to the left of the ask shows what exchange the stock is being sold from, right here. The AS column to the right of the ask shows the number of orders available at a certain price. That's right here. For each order is a contract which contains 100 stocks. For price to go higher, buyers must purchase all the orders available at a certain price point. Let's look at the screenshot. At the $136 mark, there is one contract currently available at the ask column. That's right here. For price to raise to the next level, 136.01, that contract must be purchased and buying needs to continue. At 136.01 level, there are 37 total contracts available for all the different exchanges. You can see right here 136.01 all the way down, and if you add all these up, that's where you get the 37 contracts. For price to go up to the next level, 136.04, those 37 contracts need to be purchased and buying needs to continue. See? Pretty straightforward, right? This example is similar to the Rockstar's last performance as both examples show buying pressure. A big difference in examples is the stock market is much more efficiently priced. You see, for price to raise to the next level, all the orders directly in front of it must be purchased. When selling tickets, ticket prices could be selling at a higher price, and an unknowing ticket holder puts their ticket out there for sale at a lower price, and it's consequently sold at a lower price by the ticket holder. The stock market has market makers to ensure efficient pricing. An open market selling tickets doesn't have that exact mechanism ensuring efficient pricing. Now, let's look at another example. Just picture a rock band that was just found out to be lip-syncing their songs. Before the news came out, tickets were being sold for $150 each. Immediately following the news announcement, ticket prices were dropped to $75 per ticket. A few days later, those remaining tickets were still not selling. Thus, the price was again dropped to $45 a ticket to sell the remaining ones. This is a great example of how lack of demand can push prices down. Now let's look back at the same level 2 for NVIDIA again. When investors sell a stock, they sell at the bid price, right here. The column to the left of the bid column shows what exchange the stock is being sold from, right here. The column labeled BS to the right of the bid column is the number of orders available at a certain price, which is measured in contracts. These are contracts, number of contracts available. Just the same as we discussed buying stocks, each order is a contract which contains 100 stocks. For price to go lower, sellers have to acquire all the buy orders available at a certain price level, and selling needs to continue. Let's look again at the chart at the 135.99 mark. There are 15 contracts currently available at the bid column for all the different exchanges. See right here, 135.99. If you add all these up, it's 15. For prices to decrease to the next level, 135.98, those contracts must be acquired by sellers and the selling needs to continue. At the 135.98 level, there is one contract available. See right here, one contract, 100 stocks. For prices to go down to the next level, 135.88, that contract needs to be acquired by sellers and the selling needs to continue. Same as the prior example, just in reverse. This example is similar to the rock stars being found out for lip syncing, as both examples show selling pressure. A big difference in the example is the stocks market is much more efficiently priced, as mentioned before. You see, for price to go to the next level in the stock market, all the orders directly in front of it must be absorbed, purchased. When selling tickets, ticket prices could be selling at a lower price and an unknowing buyer, unaware of what is happening, purchased at a higher price when much lower prices are available. The stock market has market makers to ensure efficient pricing, and open market selling tickets doesn't have that exact mechanism ensuring efficient pricing. For price to remain constant, there would need to be a constant flow of buyers and sellers coming into the market at a certain price. For example, for price to remain at 135.99 right here, there would need to be a steady, uninterrupted flow of buyers and sellers at that 135.99 point. Let's start by talking through the mechanics of an uptrend. Starting at the bottom of an uptrend at point 1, there are no willing sellers at this point. And for sellers to come back in the market, price must be raised. As buyers acquire all the sell orders at higher price points, price will continue to rise. This continues to point 2. At point 2, there are no willing buyers, so for buyers to come back in the market, price must be reduced. Sellers continue to acquire all the buy orders at lower prices as prices push down. This continues to point 3. At point 3, there are no willing sellers, so for sellers to come back in the market, price must be raised. As buyers acquire all the sell orders at higher price points, price will continue to rise. This continues through the rest of the shown uptrend. Now let's look at the downtrend. So starting at the top of the trend at point 4, there are no willing buyers at this point, so for buyers to come back in the marketplace, price must be dropped. Sellers continue to acquire all the buy orders at the lower price points as price is pushed down. This continues till point number 5 is reached. At point 5, there are no willing sellers, so for sellers to come back in the market, price must be increased. As buyers acquire the sell orders at higher price points, price will continue to rise. This continues to point 6. At point 6, there are no willing buyers, so for buyers to come back in the market, prices must be decreased. Sellers continue to acquire all the buy orders at the lower price points as price is pushed down. This continues throughout the remaining downtrend. At the end of the day, the forces of fear and greed have shaped the stock market. While these timeless human behaviors remain, technology now delivers information at lightning speed, accelerating market moves in a way our ancestors never imagined. Here's a golden nugget for you. Money flows from the impatient to the pockets of the patient. By taking the time now to understand how the markets really work, combined with your dedication, hard work, and genuine patience, you're laying a solid foundation for long-term success. Every step you take towards learning is a step towards a brighter financial future, and your journey is uniquely yours to shape. Thank you for watching. If you enjoyed this video, go ahead and hit like and subscribe.